August 17, 1998, in a move that stunned global markets, Russia announced it could no longer meet its debt obligations. Within hours, confidence evaporated. The government defaulted on key portions of its domestic debt, the ruble plunged, and a financial crisis that had been building for years finally erupted into the open. For ordinary Russians, the collapse felt immediate. Banks restricted withdrawals. Savings that had taken years to build suddenly lost much of their value. Imported goods became unaffordable almost overnight. Long lines formed outside financial institutions as people rushed to protect whatever money they had left. Investors reacted just as quickly. Foreign capital poured out of the country. International markets treated Russia as the latest victim in a growing chain of emerging market crises. The International Monetary Fund had already attempted to support the Russian economy, but confidence was disappearing faster than assistance could arrive. The numbers were staggering. The ruble lost a large share of its value within weeks. Economic activity contracted. Financial institutions failed. Around the world, analysts warned that Russia's transition to a modern market economy had suffered a potentially fatal blow. And the predictions seemed reasonable. History offered plenty of examples of countries that never truly recovered from a currency collapse, a debt default, and a banking crisis occurring at the same time. Once trust disappears, rebuilding it can take decades. Yet Russia did recover. Not immediately. Not painlessly. But within a few years, the same country many believed was headed for prolonged decline was experiencing renewed growth and rebuilding its economic strength. Which raises a far more interesting question than why Russia collapsed. Why wasn't this the end? When the Soviet Union collapsed in 1991, many believed Russia was about to enter a new era of prosperity. Central planning was ending. Markets were opening. Western governments, economists, and investors saw an opportunity for one of the world's largest countries to transform itself into a modern capitalist economy. On paper, the logic seemed simple: remove state controls, privatize inefficient industries, encourage competition, and economic growth would follow. The transition became known as shock therapy, a rapid attempt to replace the Soviet system with a market-based one. Reality proved far messier. As price controls were lifted, inflation exploded. In 1992 alone, consumer prices rose by more than 2,000%. Savings accumulated over decades were effectively wiped out. Families who had spent years putting money aside discovered that their life savings could no longer buy basic necessities. The economy contracted at a pace rarely seen outside of war. Throughout the 1990s, Russia's GDP fell dramatically. Factories that had once operated under state planning suddenly found themselves without customers, financing, or clear direction. Production collapsed across large parts of the economy. At the same time, privatization created enormous fortunes for a small group of well-connected businessmen. Valuable state assets from oil companies to industrial enterprises were acquired at fractions of their eventual worth. As millions struggled with falling living standards, a new class of oligarchs emerged with extraordinary economic and political influence. The institutions needed to support a functioning market economy were also weak. Property rights remained uncertain. Tax collection was inconsistent. Government authority often appeared fragile. Laws existed, but enforcement was unpredictable. For ordinary Russians, the decade became associated less with opportunity than with instability. Crime increased. Wages were often delayed for months. Public trust eroded. The promise of prosperity remained distant. Yet beneath the visible chaos, an even more dangerous problem was quietly taking shape, one that received far less attention than inflation, privatization, or the rise of the oligarchs. The answer was buried inside a financial structure that looked stable, but wasn't. By the mid-1990s, Russia appeared to be stabilizing. Inflation had fallen from its early post-Soviet highs. The ruble seemed relatively steady. International investors were returning. On the surface, the worst appeared to be over. But much of this stability rested on a fragile foundation. The Russian government was spending more money than it collected in taxes. To cover the gap, it increasingly relied on borrowing. The primary tool was a type of short-term government bond, known as a GUKO. These securities offered investors exceptionally high returns, sometimes exceeding 100% annual interest rates during periods of uncertainty. At first, the system worked. Investors purchased the bonds, providing the government with fresh cash. When the bonds matured, Russia simply issued new bonds to repay the old ones. Then it issued more bonds to cover new expenses. The cycle repeated again and again. The problem was that the entire structure depended on one assumption: investors would always be willing to lend more money. As confidence remained high, this vulnerability was easy to ignore. Foreign investors poured billions into Russian debt markets, attracted by some of the highest yields in the world. By the late 1990s, international capital had become an increasingly important source of financing for the Russian government. The arrangement resembled a pattern that had already appeared elsewhere. Just a few years earlier, Mexico's 1994 financial crisis had revealed how quickly investor sentiment could reverse. Countries that depended heavily on short-term borrowing often looked healthy right until confidence disappeared. Russia was becoming trapped in the same cycle. Each new round of borrowing increased dependence on future borrowing. Rising debt required larger interest payments. Larger interest payments required additional debt issuance. Stability was becoming increasingly expensive to maintain. Contrary to popular belief, corruption alone was not the immediate threat. Corruption weakened institutions and distorted incentives, but it did not directly trigger the crisis. The deeper problem was structural. Russia had built a financial system that needed constant confidence to survive, and confidence is one of the most fragile assets in economics. The moment investors began questioning whether Russia could continue meeting its obligations, the entire mechanism would come under pressure. What appeared to be stability was, in reality, a delicate balancing act sustained by trust. Then, a crisis thousands of miles away began changing everything. The first crack did not appear in Moscow. It appeared in Thailand. In July 1997, Thailand was forced to abandon its currency peg after months of financial pressure. What began as a regional crisis quickly spread across Asia. Investors who had once eagerly financed emerging economies suddenly became far more cautious. Markets that had seemed attractive only months earlier were now viewed as dangerous. The panic spread faster than the economic damage itself. Indonesia, South Korea, and several other Asian economies came under intense pressure. Currencies fell. Stock markets plunged. International investors began pulling money out of developing markets across the world, often with little regard for the differences between them. Russia found itself caught in this shift. The country had not caused the Asian financial crisis, but it was vulnerable to the same fear that now dominated global markets. Investors who once chased high returns began prioritizing safety. Risky assets were sold, capital flowed toward more stable economies. At the same time, another problem was emerging. Russia's economy depended heavily on commodity exports, particularly oil and natural resources. As global demand weakened during the Asian crisis, commodity prices came under pressure. Oil prices fell sharply, reaching some of the lowest levels seen in years. By early 1998, crude oil traded near $10 per barrel. For a government already struggling to finance itself, the timing could not have been worse. Lower oil prices meant lower export revenues. Lower export revenues meant fewer tax receipts. The state suddenly had less money available to service its growing debt obligations. Yet the need to borrow continued. Investors noticed. The same government that relied on constant borrowing was now earning less from one of its most important sources of income. Questions that had once been ignored became impossible to avoid. Could Russia keep refinancing its debt? Could it maintain the value of the ruble? Could it avoid default? Confidence began to erode. Foreign capital started leaving the country. Borrowing costs rose. Each attempt to reassure investors seemed to have less effect than the last. The financial system was becoming trapped between falling revenues and rising skepticism. What made the situation especially dangerous was that nothing dramatic had happened inside Russia itself. The pressure was arriving from outside, through markets, commodities, and investor psychology. The crisis years in the making was no longer theoretical. Then came the day everything finally broke. On August 17, 1998, the crisis stopped being a warning and became reality. The Russian government announced a debt restructuring that effectively amounted to a default. At the same time, it abandoned efforts to defend the ruble and widened the currency's trading band. Investors understood immediately what it meant. The financial system that had been under pressure for months had finally broken. The reaction was swift. The ruble began a collapse that would erase much of its value within weeks. Businesses that relied on imported goods suddenly faced soaring costs. Prices climbed rapidly. Contracts became uncertain. Economic calculations that had made sense the day before were suddenly meaningless. Russia's banking sector was hit next. Many banks held large amounts of government debt and foreign currency obligations. As the ruble weakened and government securities lost value, balance sheets deteriorated. Some institutions became insolvent. Others simply stopped functioning normally. Withdrawals were restricted. Accounts were frozen. For ordinary citizens, money in the bank no longer felt safe. The panic spread beyond Russia's borders. Foreign investors rushed for the exits. Billions of dollars left the country. International markets viewed the collapse as confirmation that emerging economies remained deeply vulnerable. Confidence vanished faster than policymakers could respond. The social consequences were immediate. Families watched purchasing power evaporate. Imported products disappeared from reach. Businesses cut operations. Uncertainty became part of daily life. For many Russians, the crisis felt like another chapter in a decade, already defined by instability and broken promises. The numbers reflected the damage. The currency plunged, inflation accelerated, banks failed, and economic activity contracted. What had started as a debt problem had become a full-scale financial collapse. From the outside, Russia appeared finished. The default had shattered credibility. The currency had collapsed. The banking system was in distress. History suggested that recoveries from such crises were slow, painful, and far from guaranteed. Yet hidden inside the destruction was a change few people recognized at the time. The very thing that devastated Russians would unexpectedly become an advantage. Currency collapses are usually remembered for the damage they cause. What is often overlooked is how they change incentives. Before 1998, imported goods had flooded Russian markets. A relatively stronger ruble made foreign products attractive, while many domestic industries struggled to compete. Russian manufacturers faced a difficult reality. Producing locally often cost more than buying from abroad. The crisis reversed that equation almost overnight. As the ruble lost much of its value, imported products became dramatically more expensive. Consumers who could no longer afford foreign goods began turning back to domestic alternatives. For the first time in years, Russian producers found themselves with a competitive advantage inside their own market. Factories that had operated below capacity started receiving new orders. Industrial production began recovering. Sectors that had spent years in decline suddenly became economically viable again. What looked like weakness from a financial perspective created opportunity in the real economy. Agriculture experienced a similar shift. Imported food became less affordable, encouraging greater demand for domestic production. Russian farmers and food producers benefited from changing market conditions. Industries that had struggled to survive during the 1990s found room to expand. The recovery was not immediate, and it was not painless. Millions had already suffered enormous losses, but the collapse had removed distortions that were quietly undermining domestic competitiveness. This is one of the most overlooked patterns in economic history. Some crises do more than destroy. They force an economy to adjust. Prices change. Incentives change. Capital flows differently. Industries that could not compete under old conditions sometimes become viable under new ones. Russia did not recover because every problem was solved. Corruption remained. Institutions remained imperfect. Many structural weaknesses persisted. But one crucial adjustment had occurred. The economy was no longer operating under the same conditions that had contributed to its collapse. And yet, even this rebound cannot fully explain what happened next. There was another force working in Russia's favor. Just as Russia's economy began adjusting to its new reality, the global environment started changing. In 1998, oil prices had fallen to nearly $10 per barrel, placing enormous pressure on an economy heavily dependent on energy exports. But the collapse in prices did not last. As the world economy recovered in the early 2000s, demand for energy increased, and oil began a long upward climb. For Russia, the timing was remarkable. The country was now exporting oil and gas with a much cheaper currency, making its exports more competitive while generating larger revenues when converted back into rubles. Every increase in oil prices brought new money into the economy. Government finances improved. Budget deficits narrowed. Confidence slowly returned. The impact extended far beyond the energy sector. Export earnings flowed through the broader economy. Businesses invested. Wages began rising. Economic growth accelerated. During the early 2000s, Russia experienced several years of strong GDP growth, a dramatic contrast to the instability of the previous decade. The government also learned an important lesson from the crisis. Rather than assuming favorable conditions would last forever, Russia began accumulating foreign currency reserves. As energy revenues increased, financial buffers grew. The country was building protection against future shocks, something it had lacked in 1998. From the outside, the recovery looked increasingly impressive. A nation that had defaulted on its debt, suffered a currency collapse, and endured a banking crisis was once again growing. The speed of the turnaround led many observers to a simple conclusion. Oil had saved Russia. There was certainly truth in that. But it was not the complete story. Many countries possess valuable natural resources. Many have benefited from commodity booms, yet not all of them experienced the same recovery. Some remain trapped by instability despite favorable prices. If oil alone explained Russia's comeback, the pattern should have repeated everywhere. The answer reveals a pattern that extends far beyond Russia. If oil were the entire explanation, Russia's recovery would not be remarkable. History is filled with resource-rich countries that remained trapped in crisis, despite possessing valuable commodities. Venezuela sits atop some of the world's largest oil reserves, yet years of economic mismanagement transformed resource wealth into instability. Argentina repeatedly benefited from commodity booms, yet struggled to escape recurring financial crises. The difference was not simply what these countries possessed. It was how they responded when reality forced change. Russia's collapse destroyed an economic model that had become unsustainable. The devalued ruble altered incentives. Debt burdens were restructured. Domestic production became more competitive. Painful adjustments that had been politically difficult suddenly became unavoidable. Similar patterns appeared elsewhere. After its 1997 financial crisis, South Korea restructured parts of its economy, repaired financial institutions, and returned to growth. Finland suffered a severe economic crisis in the early 1990s following the collapse of trade with the Soviet Union, yet adapted and rebuilt around new industries. The common thread was not the crisis itself. Many countries experience crises. The difference is whether the crisis forces genuine adjustment or merely delays it. This is the hidden pattern behind many successful recoveries. Economic collapses often expose weaknesses that were previously hidden by easy credit, favorable conditions, or rising asset prices. Once those illusions disappear, nations face a choice: adapt or remain trapped. Russia's recovery was accelerated by oil, but it was made possible by changes that began before oil prices recovered. In that sense, the crisis was not merely a disaster, it was also a correction. And that lesson may matter more today than it did in 1998. The conditions that contributed to Russia's crisis are not confined to history. Around the world, governments continue to rely heavily on borrowing. Global debt has reached levels that would have seemed extraordinary just a few decades ago. In many countries, economic growth is increasingly supported by credit, making financial systems dependent on confidence, low interest rates, and continued access to capital. At the same time, new pressures are emerging. Many advanced economies face aging populations, which can slow workforce growth and place greater strain on public finances. Productivity growth has also weakened in parts of the developed world, making it harder to sustain rising living standards without increasing debt. Some countries remain heavily dependent on a narrow set of exports, whether oil, minerals, manufacturing, or financial services. As Russia learned in the 1990s, specialization can create prosperity during favorable conditions, but vulnerability when those conditions change. The most important similarity, however, is psychological. Modern financial systems run on trust. Governments borrow because investors believe they will repay. Banks operate because depositors believe their money is safe. Currencies retain value because people believe others will continue accepting them. These systems can appear stable for years, even as underlying weaknesses accumulate. That does not mean every highly indebted country faces a crisis, nor does it mean history repeats in exactly the same way. But Russia's experience serves as a reminder that economic strength can sometimes be misleading. The greatest risks are often hidden during periods of apparent stability. The question is not whether today's economies are identical to Russia in 1998. The question is whether similar vulnerabilities are quietly forming beneath the surface. History's greatest lesson isn't about Russia. The story of Russia's 1998 collapse is often told as a story about debt, oil, or currency markets, but those are only part of the picture. The deeper lesson is that crises rarely create weaknesses. They expose them. Russia's financial system appeared stable for years. Investors were lending. The government was functioning. Markets were operating. Yet beneath that appearance was an economic structure dependent on confidence, borrowing, and conditions that could not last forever. The collapse did not invent those vulnerabilities. It revealed them. What happened afterward is equally important. Recovery did not begin when conditions became favorable. It began when reality forced adjustment. The devalued currency changed incentives. Industries adapted. Resources shifted. Painful corrections occurred that had been postponed for years. The crisis became a mechanism for change. History offers contrasting examples. Countries such as South Korea used crisis as a catalyst for restructuring and renewal. Others, including Argentina during several periods of its modern history, struggled to escape recurring cycles because underlying problems remained unresolved. The difference was not the severity of the shock. It was the response that followed. This is what separates national fragility from national resilience. Fragile systems depend on favorable conditions to survive. Resilient systems adapt when those conditions disappear. Russia's recovery was not inevitable. It was the result of adjustment, opportunity, and circumstances arriving at the same moment. The collapse was devastating, but it also forced a confrontation with economic realities that could no longer be ignored. That is why the most important lesson of 1998 extends far beyond Russia. Economic collapses rarely create problems. They expose problems that already existed. And the countries that emerge stronger are often the ones willing or forced to adapt after reality finally arrives.